Good morning, I'm Alex James, an independent economic analyst, and this is Macro Bullion. Today, we're looking at a question that matters far beyond Wall Street. How can the US economy continue to look strong on the surface while some of the underlying signals are becoming increasingly difficult to ignore? The headline story is still remarkably positive. US companies remain optimistic, investment is strong, artificial intelligence is driving a huge wave of capital spending, and financial markets continue to show confidence. Citigroup CEO Jane Fraser described the American financial system and capital markets as a major global strength, while pointing to continued investment and resilience across the economy. But there is another side to this story. The Wall Street Journal's Greg Ip recently highlighted what he calls a very unusual economic environment. Markets and corporate earnings are performing strongly, yet that strength is not translating into the kind of job creation normally associated with a healthy expansion. July employment actually declined, and he pointed out that weak hiring has become an unusually persistent feature of the current cycle. That creates a very important question for gold and silver investors. If economic growth remains resilient but hiring weakens, what does the Federal Reserve do? Does the Fed focus on sticky inflation and remain cautious? Or does it eventually respond to a weakening labor market? And what happens to bullion if those two forces begin pulling monetary policy in opposite directions? This is where the story becomes much more interesting. The latest discussion also shows that inflation has not completely disappeared. The source material cites July CP1 at 3.4% year over year, while core inflation cooled to 2.5%. At the same time, Fraser warned that another disruption around the strategic shipping straits could push energy prices and supply chain costs higher again. So the Fed is potentially facing a difficult combination, a labor market that is losing momentum, but an inflation environment that may still contain upside risks. And for gold, that combination matters. Gold does not simply react to whether the economy is strong or weak. It reacts to the changing expectations around interest rates, real yields, inflation, the dollar, financial stability, and geopolitical risk. Silver adds another layer because it is also heavily connected to industrial demand and global growth. That means the real question is not whether the US economy is booming or slowing. The real question is whether the apparent strength can continue without stronger job creation, and whether the Federal Reserve can keep policy restrictive if the labor market continues to deteriorate. That is the tension we need to watch. Because if the economy remains strong enough to support corporate profits, but weak enough to force a change in monetary expectations, bullion could find itself sitting directly in the middle of that policy conflict. And that is where the next move in gold and silver could become very interesting, but this is where the economic picture becomes more complicated. On one side, corporate America is still talking about investment, innovation, and expansion. On the other, the labor market is showing signs that demand for workers may not be nearly as strong as the optimism in financial markets suggests. Greg Ip highlighted that hiring is running at roughly half the rate seen in the year before the pandemic. July was another weak month for employment, and the weakness in job creation has now appeared repeatedly rather than looking like a single isolated number. That distinction is extremely important. A slowing labor market does not automatically mean recession. In fact, the discussion points to an unusual situation where the economy can continue growing while employment growth remains weak. One explanation is productivity and technology. If companies can produce more with fewer additional workers, corporate earnings can rise even when hiring does not. And artificial intelligence may be accelerating exactly that process. Companies are investing heavily in AI infrastructure, energy, and technology. Citigroup's Jane Fraser described the current phase as the picks and shovels stage, where businesses are spending heavily on the infrastructure needed before the productivity benefits become fully visible. She expects the next phase to be more of a builder's era, where those investments could translate into new revenues, faster products, and productivity gains. For the stock market, that can be a powerful combination. Higher productivity can support earnings without requiring equally strong growth in employment. That helps explain why financial markets can remain optimistic even while labor market indicators look softer. But for the Federal Reserve, the situation is much harder. Historically, policymakers have watched unemployment, wages, and job vacancies as important signals of whether the economy is overheating. Yet the current environment is different. Wage growth has been slowing, while labor demand also appears relatively soft. The discussion points to hourly earnings rising only about 3.2% year over year, with longer-term unemployment also increasing. At the same time, inflation remains sticky. That creates a potential policy trap. If the Fed sees weak hiring, it has a reason to consider easier monetary policy. But if inflation remains above target, or if energy prices rise because of another geopolitical disruption, cutting rates too aggressively could create another inflation problem. And this is exactly where the gold story becomes more powerful. Gold benefits when investors begin to expect lower real interest rates, greater monetary accommodation, or increased economic uncertainty. But gold can also face pressure if inflation forces the Fed to remain restrictive and keeps real yields elevated. So the direction is not simply weak jobs equals higher gold. The real transmission mechanism is expectations. Weak employment leads to greater probability of easier policy, leads to potentially lower yields, leads to potentially weaker dollar, leads to stronger support for gold. But another chain is also possible. Geopolitical disruption leads to higher oil prices, leads to renewed inflation pressure, leads to Fed stays cautious, leads to yields remain elevated, leads to short-term pressure on gold. That conflict is now one of the most important things to watch. And silver could be even more sensitive because it sits between monetary demand and industrial demand. If AI investment, electronics, and infrastructure spending remain strong, silver could benefit from the industrial side. But if global growth deteriorates sharply, that industrial exposure becomes a vulnerability. So the market is not facing one simple bullish or bearish signal. It is facing a collision between strong corporate investment, weak hiring, sticky inflation, and geopolitical inflation risk. And the Federal Reserve is right in the middle of that collision. That is why the next major move in gold and silver may depend less on one headline number and much more on which side of this economic conflict ultimately becomes dominant. Now, we get to the part that matters most for bullion investors. What does this unusual economic setup actually mean for gold and silver? The first thing to understand is that the market is dealing with two competing forces. One is disinflation and weaker labor demand, which can eventually support easier monetary policy. The other is the risk that energy and supply chain disruptions create another inflation impulse. And when those two forces collide, the Federal Reserve becomes extremely important. Jane Fraser specifically identified the strategic shipping straits as a major unknown. Her concern is straightforward. If disruption returns, oil prices could rise, supply chains could tighten, and inflation could move higher again. She also emphasized that the impact would be much larger internationally, particularly for economies that depend heavily on imported energy and critical industrial inputs. For gold, that creates an interesting paradox. Normally, higher inflation can support gold because investors look for protection against declining purchasing power. But if inflation rises because of an oil shock while the Federal Reserve responds by keeping monetary policy tighter for longer, higher yields can create short-term pressure on gold. So investors need to separate inflation itself from the market's response to inflation. That distinction is critical. Imagine oil prices move sharply higher. The immediate reaction could be negative for risk assets and positive for inflation expectations. But if markets conclude that the Fed will have to remain restrictive, Treasury yields could rise and the dollar could strengthen. That can temporarily make gold less attractive. Now reverse the scenario. Suppose the labor market continues weakening, hiring remains subdued, and economic momentum starts deteriorating. If inflation simultaneously continues cooling, markets could begin pricing a more accommodative Fed. In that environment, falling yields and changing rate expectations could provide a much stronger foundation for gold. This is why bullion investors should not watch only the gold chart. They need to watch the Fed, Treasury yields, the dollar, inflation expectations, and labor market data together. Silver adds another layer to this equation. The source material presents AI investment as a major driver of capital expenditure, not only in computing infrastructure, but also in energy and the broader technology ecosystem. Fraser argues that the next stage could bring productivity gains and new products as these investments begin translating into economic activity. That matters for silver because its story is not purely monetary. If AI infrastructure, electronics, energy systems, and industrial investment remain strong, silver can receive support from continued industrial demand. But if the apparent economic strength turns into a genuine slowdown, silver could face a more complicated environment because industrial demand is more economically sensitive than gold. And this gives us an important distinction between the two metals. Gold is increasingly a monetary and macro hedge. Silver is both a monetary metal and an industrial metal. So if the economy slows but monetary policy becomes easier, gold could potentially outperform initially. If economic growth remains resilient while industrial investment accelerates, silver could have another powerful tailwind. But there is an even bigger issue emerging underneath the surface. The labor market may be changing structurally. Greg Ip argues that the current weakness in hiring may not simply be a temporary cyclical slowdown. He points to low population growth, weak labor force expansion, and increasingly cautious corporate hiring. At the same time, businesses are becoming more productive, and technology may allow companies to expand output without proportionally expanding their workforce. If that becomes a long-term trend, the implications could be much bigger than one weak jobs report. It could mean that markets become increasingly dependent on productivity and capital investment rather than employment growth. And that creates a very unusual economic environment. Strong profits, strong investment, and strong equity markets existing alongside weak hiring. For bullion, that is a warning not to rely on traditional recession signals alone. The market may be entering a period where the old relationships between growth, employment, inflation, and monetary policy become less predictable. And when traditional relationships become less reliable, the value of macro analysis becomes even greater, because the next major gold and silver move may not come from the headline everyone is watching. It may come from the relationship between the numbers that appear to contradict each other. Now the question is whether this unusual economic environment can continue, and more importantly, what could break it. At the moment, there are still genuine reasons for optimism. Corporate investment remains strong, AI spending is expanding, and Citigroup's Jane Fraser sees several tailwinds supporting U.S. growth, including tax changes, deregulation, and continued investment. She also expressed confidence in growth extending into 2027. But that bullish picture has a major wild card: inflation. If productivity continues improving, companies can potentially grow without creating massive additional labor demand. That could keep corporate margins strong and allow the economy to expand even while hiring remains subdued. Greg Ip points out that companies are seeing wider profit margins, partly because revenues are rising without equivalent increases in employment costs. For equities, that can remain supportive. For the Fed, however, it creates a much more complicated calculation. The central bank has to determine whether inflation is being generated by labor market pressure or by other forces such as energy, tariffs, and technology-related investment. Greg Ip highlighted the possibility that the current inflation dynamic may be different from the traditional wage-driven cycle, with prices potentially leading wages rather than wages leading prices. That distinction could become critical for gold. If inflation remains sticky because of supply-side pressures, the Fed may have less freedom to respond quickly to weakening employment. In that scenario, monetary policy could remain restrictive even as the economy loses some momentum. But if inflation continues cooling while labor demand weakens, the balance changes dramatically. The Fed would then have greater room to support the economy, and markets would likely begin reassessing the path of interest rates, treasury yields, and the dollar. That is the environment where gold can become increasingly interesting. There is another important signal coming from the labor market itself. The discussion points out that job changers in sectors such as construction, manufacturing, and natural resources have experienced significant wage gains, while broader official wage measures appear much softer. That creates uncertainty over whether headline labor statistics are fully capturing what is happening underneath the surface. So investors should be careful about declaring the labor market either strong or weak based on one number. The real picture appears more fragmented. Some workers and industries are experiencing strong wage pressure, while overall hiring remains subdued. That fragmentation matters because the Federal Reserve is looking at the entire economy, not just one sector. And then there is the geopolitical risk. Fraser warned that another disruption involving major shipping routes could create higher energy prices and renewed supply chain pressure. She described current international buffers as much thinner than they were earlier in the year. For gold, this is potentially important because geopolitical shocks can increase demand for defensive assets. For silver, the reaction could be more complicated because industrial demand remains part of the equation. So my base case is not that gold and silver will move in a straight line. The more likely environment is one of higher volatility and conflicting signals. If growth remains strong, industrial demand could continue supporting silver. If labor weakness intensifies and inflation cools, expectations for easier monetary policy could strengthen gold. If geopolitical disruption pushes oil sharply higher, inflation expectations could rise and create short-term volatility across both metals. And if these forces appear simultaneously, the market could become extremely sensitive to every major Fed, inflation, and employment release. That is why I believe the biggest mistake investors can make here is focusing on a single narrative. This is not simply a recession trade, it is not simply an AI boom, and it is not simply an inflation trade. It is a collision between productivity, employment, inflation, monetary policy, and geopolitical risk. And when those forces collide, bullion can become one of the clearest places where the market expresses its uncertainty. The final question, therefore, is not whether gold and silver have a bullish or bearish story. The real question is which force wins the next phase of this cycle ***. So where does this leave gold and silver from here? My view is that the market is entering a phase where the headline economic numbers may become less important than the direction of the underlying forces. Right now, the US economy is showing resilience. Corporate investment remains strong, AI spending is accelerating, and there are still meaningful tailwinds behind growth. Jane Fraser argues that the combination of investment, deregulation, and tax policy could support continued expansion into 2027. But at the same time, the labor market is sending a very different message. July employment declined, hiring has remained unusually weak, and broader measures of labor demand are showing signs of cooling. Greg Ip argues that this may be more than a temporary cyclical weakness, with structural changes in population growth, technology, and corporate hiring potentially reshaping the labor market. That gives us three major scenarios. In the first scenario, the economy remains resilient, inflation gradually cools, and the Fed gains room to become less restrictive. This would create a potentially favorable environment for gold because lower rate expectations and declining yields could strengthen monetary demand for bullion. In the second scenario, growth remains strong, but geopolitical disruptions push oil and supply chain costs higher. Inflation expectations could rise, forcing the Fed to remain cautious. That could create short-term pressure on gold through higher yields and a stronger dollar, even while geopolitical uncertainty supports safe haven demand. The third scenario is the most complicated. Growth slows significantly, employment weakens further, but inflation remains sticky. That is the policy dilemma. The Fed would want to support economic activity, but persistent inflation would limit how quickly it could ease policy. Markets could therefore experience significant volatility as investors repeatedly change their expectations for rates. And this is where I think gold becomes particularly important. Gold does not need a traditional recession to perform well. It can benefit simply from rising uncertainty around monetary policy, inflation, currencies, and financial stability. Silver has a different setup. If the AI investment cycle continues expanding into energy, electronics, and infrastructure, industrial demand could remain supportive. The source material describes AI investment as moving beyond computing infrastructure into a broader ecosystem involving energy and other parts of the economy. But silver also carries greater economic sensitivity, so if the US economy stays relatively strong, silver may have an opportunity to benefit from both monetary and industrial forces. If growth deteriorates sharply, gold could potentially become the cleaner defensive trade. That is why I would not treat gold and silver as identical assets in this environment. The bigger signal I am watching is the relationship between employment, inflation, and Fed policy. If hiring continues weakening while inflation cools, the probability of easier monetary conditions becomes more important. If inflation reaccelerates because of energy or geopolitical shocks, the Fed may remain constrained. And if both happen together, weak growth with persistent inflation, volatility could become the defining feature of the bullion market. So my conclusion is simple. The US economy is not currently presenting one clean story. It is presenting two stories at the same time: strong corporate investment and weak labor market momentum. That contradiction is exactly what makes the next phase so important for gold and silver. Watch the jobs data, watch inflation, watch treasury yields, watch the dollar. And above all, watch how the Federal Reserve responds when those signals begin moving in different directions, because the next major bullion move may not be triggered by a spectacular headline. It could begin quietly with a change in rate expectations that the broader market initially ignores. And if that shift arrives while geopolitical and inflation risks remain elevated, gold and silver could find themselves back at the center of the macro story. This is Alex James for Macro Bullion. I'm an independent economic analyst, and as always, this analysis is for information and educational purposes only. Do your own research and consider your own risk before making any investment decision. The big question now is not whether the US economy is strong, it is whether that strength can survive a weakening labor market without creating a new problem for the Federal Reserve. And that is the question I'll be watching next.